Hello, I'm Shay Sharma from the REC team, and today I am going to talk about pre-construction, and this is an entire pre-construction masterclass. I have my friend Laura Stewart here from the REC team, and we're going to be discussing pre-construction at length today. Welcome, Laura.
Yes, well, thanks for having me. I love this topic. I've been in the real estate industry for over a decade now, and I've seen a lot of first-time home buyers and investors use this strategy. So I'm excited to get into it, and I think the best place to start is to actually maybe have you explain what is a pre-construction condo, because a lot of people don't quite know.
Cool. So a pre-construction or buying a pre-construction unit is essentially buying a separate unit in a building, but the building is not there yet. It's yet to be constructed, anywhere between, let's say, 3 to 8 years. So you're essentially buying off of floor plans. So you know who the developer is, you know the location of the building, you have some renderings around how the building is going to look like, and you know how the unit is going to look like based on the floor plans, but you don't have anything to touch and feel as of now.
Right? Yeah, you can't see it yet. You can't drive by it, but you get a good idea, I think, from the renderings and from what's on paper. So definitely, and it's fun, right? Because you can start to envision what it could possibly be and how that building might change, forever the face of the city that you're buying in. What are some of the advantages of buying pre-construction condo?
Well, there are a ton. Let's talk about a couple for now. So I guess the biggest advantages, or the biggest advantage in this case, is that there's no need for you to take on a mortgage right now. And it's equally beneficial both for first-time buyers as well as investors. Now, if you are a first-time buyer, let's say you're somebody new to the country, you do have some money, but because you're new to the country, you'll not be eligible for a mortgage today. So you can invest in a pre-construction condo, so that you make some payments right now, some payments over the period of the next 3 to 5 years, and in that time frame you can get your ducks in a row and get qualified financially and then close on the property, and that is when you take on a mortgage. On the other hand, if you're an investor and let's say you're sitting with a couple of properties already, the banks might deem you over leveraged at this point because you have too much mortgage already. But you do have some money to be invested. So what you can do is, again, invest in pre-construction so that you can put in some money right now, and again, over the next few years, pay 5% here, 10% there, and get qualified for a mortgage in about 2 to 4 years. I think there are a couple of more advantages of pre-construction investment that we should talk about.
Okay.
And those are, the second one being the deposit structure. Now, again, let's say you're an investor. You have to buy $1 million property, so if we consider resale, you have to come up with $200,000, because we know in Ontario we need 20% down. So you need $200,000 in about 60 to 90 days. But if you invest in pre-construction, again, you can spread out that deposit over a few years time frame. So the third one that we all love as investors is the passive appreciation. And this is the strategy, or this is the advantage where we see the leverage come into play for real estate. Now, consider this. Let's say you buy a $600,000 condo and you put 5% down in year one, which is $30K. But the market appreciates by 5% during that 1 year, which is not abnormal, because if we see overall in the GTA, the market consistently has appreciated at about 7% in the last 40-50 years. So consider 5% appreciation on your $30,000 payment in year one. So you've already made $30,000 in year one, which is 100% return on investment, which is great. Now let's go conservative.
Yeah.
Let's go 2.5% appreciation. Now, mind you, the appreciation is not only on the initial amount, but on the entire price of the unit. So you've paid 2.5% appreciation, which is 15K on the entire purchase price, which is still 50% return on investment, which is, again, tremendous.
Wow, that almost sounds too good to be true. And generally speaking, what I know, people say when something sounds too good to be true, maybe it is. So why don't you share with us maybe some things that people should consider before making this type of purchase? Because I imagine it's not right for everybody.
Absolutely, it's not. And I think the couple points we're going to talk about now are going to resonate with a lot of people, because these are a couple concerns that I hear very, very often. So the first one is, what if the builder doesn't deliver, right? What if the project does not take off? So let's say you've signed up for a unit, you've paid your deposit over the next couple of years, as promised, you've upheld your end of the commitment, but the builder decides to cancel the project. Does it happen? Yes. but it's very infrequent to happen. It happens less than 2% of the times, although it's a different story that we see it all over the media when it happens. So you feel like every project is getting cancelled out there, but that's not actually true. So it's less than 2%, but I totally understand nobody wants to be in that 2% as well. So you want to keep your money safe, completely understandable, and that is where we come in, because we look at the builder reputation even before we bring the project to you.
Right.
So when I say builder reputation, somebody who has delivered the project or similar projects in the past, not one or two but multiple. They have good financial standing, right? They have good quality of finishes. So when we bring a project, we make sure that the builder reputation is the best, or we pick the best builders for you. Hence, we mitigate the risk of the project not coming to completion. Now, never say never. So let's say worst case scenario, the builder does not complete the project or the building does not get built. You still get all of your money back. How? Is because the money never goes to the builder directly. It always goes to the builder's lawyer's trust account. So it's always safe there. If the project gets cancelled, you get the money back with interest. So essentially, all you're losing at this point is the opportunity cost. Now, let's say the builder gave you your money back at 3% interest, but had you invested the money elsewhere, you could have got 5%. Right? So the delta of 2% is what you're losing on, but your money is safe, you get it back with interest.
Okay, so it's a relatively safe investment, but like any type of investment, there are risks. I think one of the major risks that people talk about are what happens, or what should I consider when I think about values of my property? Like what happens if values actually go down and my property might be worth less when I close than it is today?
Right, very legitimate concern, and the answer is yes, the values could go down. Because we all know real estate goes up, down, upwards. So what we're saying is there are minor dips in the market, but if we consider a long-term time horizon, real estate always goes up. Why I say that is because if we consider the last 40, 50, even 100 years of data in the GTA, we've seen real estate appreciating by 6.73% precisely. For the sake of this conversation, let's call it 7%. So what that means is if you hold on to your property long term, the prices would double every decade. Every 7 to 10 years, you'll see the price of your property double. Now, the only reason people get burned in real estate because they treat real estate as a get-rich-quick scheme. What I mean by that, so if you're coming in with an intention of buying a pre-construction unit, selling it in assignment, let's say over the next 6 to 18 months, and walking away with a pile of cash, maybe real estate is not the best investment for you. Because what we propose, or we're strong proponents of in the industry, is come in with an intention to close on the property. So even if the values go down, let's say in the next couple of years, you close on the property, you hold on to it for a little while, and if you hold on to it, let's say until closing, or maybe even a couple of years beyond the closing, you will make money. Or the probability of you making money is way higher than if you're just speculating in the market and you're in the market just to sell on assignment.
So all sounds great. A lot of our clients get to this stage and they're like, look, I get the investment strategy from a high level. I understand the things to consider. I understand what the many advantages are. But where I think a lot of people get stuck is kind of in that paralysis by analysis, right?
Absolutely.
Like they're thinking, okay, great, I want one. And now what do I do? How do I pick? I mean, there's cranes everywhere in the greater Toronto area. Where do you look? Where do you start? How do you pick the right project and the right builder?
Right, you're absolutely right. I mean, I believe, and I might be wrong about this, but Toronto is the second city in the world with the most cranes in the sky.
Yeah.
So yeah, I understand picking a project could be a daunting task in itself. And this is where we come in as experts as well. So the first thing that we look at, and we've spoken about it a little bit, but I'm going to touch upon it more, is the builder reputation. I think that's the first and foremost thing, the most important one to consider. So you see a builder who has done it in the past, delivered multiple similar projects, delivered on time, has a good financial backing, and somebody who really promises or delivers what they promise. So the features and finishes that you see on paper are those the ones that you're getting. You know, when you do the PDI, the pre-delivery inspection, do you see the quality of finishes, up to the mark?
Does it match the rendering?
Exactly.
So much. So
exactly.
Yeah.
And then Something as simple as going on Google and looking at builder reviews, because those reviews are coming from people who are living in those buildings, those units, and those people can tell you what the quality of finishes look and feel like, right? So builder reputation is definitely the first one. The second one that we definitely look at is something that's close to transit. So why is it important? Now let's call Toronto the sun,
Okay.
right? The center of our galaxy, so to speak, and all the cities around it, the different planets. So it's always beneficial for you to be closer to the sun, because that's where you get more appreciations. That's a very stable market to be in over the long term. However, it comes with its own challenges in terms of at a higher price point and higher rents. So as an investor, even if you can't, let's say, invest in Toronto because of the high entry point or high price point, invest in the other cities, but make sure you're closer to transit, because guess where the jobs are? In downtown Toronto. So even if you're investing elsewhere, make sure you're closer to transit so that your clients, your tenants, can commute and come to downtown if they work here.
So I guess what you're saying then is the old adage kind of rings true in that when you're buying real estate, location, location, location still matters today.
Absolutely. Always has, always will. In fact, there was a study done by the Harvard Business School back in 2016, 2017, which showcased in terms of numbers that the appreciations and stability in the market is actually better when your unit or your building is within 500 meters of any major transit hub. So as far as Toronto is concerned, or the GTA, it could be the subway, it could be the GO station, it could be an LRT line. So as long as you're close to these things, I think you can expect better or above average appreciation.
Right, and actually speaking from a tenant's perspective, because I've been a tenant,
Yeah.
and I know just how important it is to be close to a transit line, because you don't really want to be walking for an hour just to go from the transit line to your property, right?
Absolutely.
I'm curious, is it just transit lines then that we should be looking for?
No. So there are other things to consider. So let's say there are something called a master plan community, right? So a master plan community is a place wherein, let's say, 2 or even 3 levels of government are pumping in money, and the idea is to completely redevelop that whole neighborhood. Now, condos are a big part of these communities. You could see developers, one or many, developing that community at the same time. But in addition to condo buildings, you have retail space, you have offices, commercial. So we're essentially creating a city within a city. And the idea is that you have one place where you can live, work, and play. So you don't necessarily depend on transit as much now.
Okay, because you kind of stay in that community and you
Exactly.
do everything there, so you don't
Right.
necessarily need access to transit. I like that idea. I'm curious, a lot of people, right, get overwhelmed by the amount of paperwork when it comes to condos and about best protecting themselves. Because again, you hear a lot in the headlines about people being, confused on closing, or there's these things that they didn't anticipate. So what are some things that people can kind of do to protect themselves?
Sure. Let's go over a few things, and the whole idea is to mitigate any risk and surprises at the time of closing, right? So the first thing that you've got to look out for in the agreement of purchase and sale is a few incentives, but the very first one being the capped development charges. Now, let's first understand what development charges are. So let's say a building is now being constructed, but it can't be a standalone building. It has to have, let's say, stop signs and red lights and parks for the residents, sewer lines, for example, and all these things take money from the city to be developed. Now, the city will not pay for it, so it'll slap a bill to the developer, asking the developer to pay, and the developer is unfortunately not gonna put this money.
They're not going to put the cash up themselves?
Exactly. So they're going to pass this on to you as consumers. So the challenge here is we don't know what the development fees is going to look like 3 to 5 to 8 years from now. So the idea here is to cap the development charges. Let's say we cap it at $10,000 for example, a 2-bedroom, 2-bath unit that a consumer booked. Now, if at the end of the day, at the time of closing, the development charges come out at $15,000. Guess what? You as a consumer are only paying $10,000. The remaining $5,000 are getting paid by the builder. On the other hand, if the development charges come out at $8,000, guess what? You're paying only $8 and not $10. So it's a way for you or for us to protect the consumer.
Okay.
The other thing that you got to look out for is assignment clause, right? We make sure that we always have assignment clauses built in for the consumers so they have an out in case life happens. So we've already spoken about the fact that we don't ask our consumers to go in with the mentality to assign. We want them to close and see the maximum potential of that investment.
Sorry, and I just want to make it kind of clear because I think I've heard the term flip the paper a lot, right? I feel like that's the street term for assignment. So if people haven't heard the term assignment or you hear reassignment, it really is an assignment. And like you said, that's really there just in case, right?
Just in case, yes. So in the next 3 to 5 years, for when you're holding on to the unit or it's still getting constructed, life could happen. There could be changes in your your financial situation, and maybe you just can't live in that property anymore. You can't hold on to that investment. So it's always good to have the assignment clause built in so that you can flip the paper, assign it to another buyer who's willing to, get into that investment. But again, go in with the mentality to close. If you gotta assign, you can, because we will make sure that that clause is built into your agreement of purchase and sale.
Okay, and then where do people come to for that, to do an assignment? Like, do they come back to you?
Oh, absolutely.
Yeah.
Absolutely. We have a huge database of buyers and investors who are looking out for opportunities all the time. So in case you do need to assign, we can always help out with that as well.
Okay, now I believe there is one more incentive that's particularly important. Specifically if you're an investor. So maybe not so much for end users, but as an investor. Can you explain on that?
Right. And that is the right to lease during occupancy. Now, before I even go into it, let's first understand the difference between occupancy and closing, because for low-rise developments, it's not always the case. But in condos, let's say we have an occupancy date. This is the date when you get the possession, you get the keys to the unit, and you're good to start living in the unit if you are, let's say, an end user, a first-time buyer, or you can rent the place out starting the occupancy date. At this point, however, you should note that the unit is ready, all the safety checks in the building are done, so you can pretty much occupy the unit. So some parts of the building are still under construction. So let's say the gym, the pool, the sauna, they're still under construction, but you're good to occupy the unit. As an investor now, you can rent the unit out immediately after the occupancy date. So you still need to pay something to the builder every month because you don't own the property yet, because the property hasn't been closed, which will be done on the closing date, which could be 3 to 6 to even 8 months after the occupancy date. And this is the date when the condo corporation gets registered with the municipality. So that's the day you close on the unit, and that's the day you start the mortgage on the unit. So between the occupancy and the closing date, you can either live in the unit as a first-time buyer, or as an investor, you can rent the place out. Okay. And that's the time where you're gonna see some positive cash
flow. Now you can only rent it out if you have this incentive in writing.
Absolutely, absolutely. And mind you, some builders don't even like to give this incentive because they don't wanna deal with the tenants. Let's say a consumer is unable to close on the unit, they don't want to assume the tenants. But we make sure that our clients do get this privilege, do get this incentive. So what happens between the occupancy and closing, that you rent the place out, you still pay something to the developer in terms of the property taxes, the maintenance fees, and the interest due on your portion of the remaining down payment. However, you might still see some positive cash flow because the mortgage hasn't started yet, right? So that's a great incentive to have, and it will also be beneficial in terms of your HST, which we're going to cover in a few minutes.
Okay, I'm curious then as well. Like you talked about, obviously you can help buyers with purchasing a pre-construction condo. You can help them with assignment. Do you also help with the renting of the unit? Because a lot of people, people don't necessarily invest in properties where they live, right? We at REC Canada, we have clients who are buying from Vancouver, but they're buying in the GTA because they believe in the GTA HA.
Right. So honestly, our approach is to be a one-stop shop, a service provider who can take care of everything for you. So be it assignments, be it renting, buying, selling, we cover it all.
Okay, good to know. Good to know. We're coming to you for everything, all the problems. Now the good news is about condos is that not much goes wrong with them. So at least from a landlord's perspective, we don't have to go into that. On closing, so we talked about the occupancy, that time period, and then closing happens. Of course, that's when I get the mortgage. Can you touch on what some of the other closing costs might be, just so I'm not, there's no confusion, or I'm not like slapped with a bill that I didn't anticipate or save for?
Yeah, we already covered the development cost, right? So we got to cap that. That's a part of your incentive package. Now the second is the legal cost, so the lawyer fees in simple terms. The third is the land transfer tax, and the fourth one, which is a little tricky and something that I'd like to explain in further detail, is the HST. Now, as a first-time buyer, if you're buying a pre-construction condo, there is no HST because that HST cost is built into the unit price that the developer is offering you. It gets tricky, however, if you're an investor. Now, essentially, you gotta pay 13%, a myth, 13% is not the price that you pay for HST, it's 24,000 capped. So it's a maximum of 24K. Now, once you pay it, you can actually get most of it back. But you might say, okay, you pay 24 and you get 23,000 and change back from the government. So what's the whole point? Now, the point here is related to a much bigger problem that we have in the GTA, which is the housing crisis. Now, Toronto is a world-class city. People invest in cities like Toronto all across the globe, not always to rent them out or to even live in them, but just as an investment vehicle.
Right, so to park their money, so to speak.
Exactly. So that's why in all the major cities around the world, we see buildings and none of the lights are ever on, right? People are not living in those condos. And that's what the government does not want, right? So they want investors to buy the unit and then rent them out as well, because we not only have a housing shortage, but a crisis.
A crisis, yeah.
Right? So now, as long as you can close on the unit and staple a 1-year lease agreement and send it off to the government, proving that yes, you've rented the place out for at least a year, you're gonna get most of your HST back.
Okay.
But yes, there is certain admin fee, which is a couple $100s, but you essentially get most
Right.
of the
The
back.
government has to put a stamp on your mail, so
Somebody's
you're
got
gonna
to
pay for it.
open that mail, so there's admin fee to it.
And
but
I think
that's
roughly
all.
what's the time period that you have to wait until you get your HST
So
back?
roughly 2 to 3 months.
Okay, so it's not that long.
No.
And I think ideally what happens here is because we've rented it out way on occupancy, right?
Mhm.
Because we have the right to lease during occupancy. So you already
Right.
have that lease
Absolutely.
agreement in place. So by the time you
Absolutely.
close, you literally pay your HST
Mhm.
and then you submit the application like the next
Right.
day and you wait your 2 to 3 months. But your warning to everybody is make sure that you save for that 24,000 because you will need it on closing.
Exactly.
Now the only caveat here is I guess if you're not if you're not renting it out, you don't get
Mhm.
that 23 and change back.
Oh yes, yes.
Okay.
Yeah, yeah. If you don't rent it out, no
Nothing,
HST is
nothing
coming
comes back to you.
Yeah.
And I guess some investors choose to do that still.
Yes, and on top of that, now we have the Toronto vacancy tax as well. So a couple things you might want to consider if you decide to just park your money and not rent the place out, because it's going to cost you more.
Okay, and that's how the government's really trying to crack down on this
Yes.
vacancy
Yeah.
issue. So how do I really win with this investment?
Well, timing. Timing is everything in pre-construction, and I am going to talk about the first access pricing. Now, it's imperative to consider the point at which you're entering the market. Now, when a new project is launched, believe it or not, the builder does not want to sell all the units in a week. They
Right.
don't want that to make the most money. Simple. So what they do is they release a few units at any given point of time, and they do it in phases. So the very first phase, it's the friends and family phase. Let's call it.
Okay.
So anybody, let's say, who's working in and on that project gets access. So
Okay, like the
tradespeople,
construction work. Okay,
the
got it.
tradespeople,
Yeah.
right? Now, the second phase is where we come in, the platinum brokers, right? So we have the first access immediately after the salespeople, which is the best price point the consumers can get access to. Now, anytime as a consumer you see a board which says open to public, and you walk into a sales center and you're greeted well and the salespeople are spending time with you, trust me, you've lost the opportunity to make money in that project.
Why?
Because
So it's too late already.
it's too late.
Okay.
I mean, that could be phase 5 or maybe 6 at that point. So what happens in different phases is each phase, so let's say the builder launched 20 units in phase 1, 20 units in phase 2, wherein we come in as the platinum agents. And then they really see how the demand and supply is working, and they formulate a strategy wherein they can release certain units in certain point of times and make the most money.
Okay, so they kind of base it on supply and demand, I guess.
Exactly.
And then if there's enough demand out there, they're going to increase prices.
Absolutely. Each phase, you can see about 15 to 20K appreciation in the price point, which is also called force appreciation. For the first few months, as these phases are launched, each phase comes out with a higher price point, and you do see some appreciation only if you entered at stage 1 or stage 2.
Okay, so literally, as a buyer, I sign the paperwork, I go firm on my pre-construction condo, and you're saying that technically speaking, a couple months later, on paper, I've actually made some money already
Absolutely.
on my investment.
You have.
And I haven't done anything.
You haven't, but that's not when you sign. Because assignment, again, comes with a timeline. It's usually 6 months before the closing.
Okay.
So don't mistake
Okay, so
that
don't
appreciation.
mistake the money on paper as money in my pocket quite yet.
Exactly.
Okay, so
Okay.
that's incredible. Now, I have a curious question. Is it only during first access prices that I would ever want to buy a condo? Like, what if there is something like maybe it's phase 5? Can I win during that part of the process as well?
You sure can. Like, sometimes the prices don't even go up because the demand and supply is working in a certain way where the builders don't see any incentive in increasing the price because they know they're going to curb the demand in that case.
Okay.
So sometimes the prices don't go up as much and the incentives could be better. So even though you're not in at, right at the start of the process, but sometimes, generally speaking, it's okay for you to get into phase 5 or 6 as well, depending on the market.
Okay, so what is the process of actually putting pen to paper here? Like, what do I go step by step through just to secure myself a unit?
Right. So assuming you get in at the right point, we have access to, let's say, 20 units. We sit down with you, we go through all the floor plans and pick the best floor plan for you, depending on, the price point, the size of the unit that you want to go for. Once we've picked up the unit, the process from here on is very, very fast. And you've got to understand that as a consumer, because now as soon as the unit is picked, you got to sign the paperwork, submit the worksheet, and submit the checks, the initial draft, let's call it. Now, right now, I know I'm asking you to do something which your mom and pops have always asked you not to do, which is signing before you read the papers. But that's what is required in pre-construction. But we're still okay and we're still safe because in Ontario, what we get is a 10-day due diligence period. In this period, what we will do is bring in a professional real estate lawyer who's an expert in pre-construction, hand over all those documents. I mean, you can review it yourself as well, but honestly speaking, those are real estate jargons, legal terminology that people like you and me
I
are
have
not
read through some
great
of them
at.
before. If you want to put yourself to sleep,
Yeah.
you can sit down at
They
night
are
in your
boring.
bed and start reading through these.
Absolutely. And it's a lot of paperwork. It's like 50 pages of a legal contract, and if you add on the condominium documents to it, it's another 150 pages. So as a consumer, I don't expect you to read through those 200 pages and make sense of it. So the lawyer is going to do that for you, right? And at this point, the fact is we get about 70 to 80 projects on our desk every year, out of which we get loud about only 6 to 8 projects. So when we come in with a project and we get loud about it, we've essentially done all the heavy lifting up front. We know exactly what's there in the contract, exactly what the lawyer will come up with. So that 10-day due diligence period essentially is a formality at this point. But if life happens, something comes up, if for any reason you are unable to go ahead with that transaction, all we got to do is let the developer know before the 10-day period that we are unable to go ahead and the purchase is cancelled.
Okay, and I just want to make this clear. If I say on day 11,
Yeah,
tell you, what happens?
nothing.
Okay, so
Now
I'm
we
firm
locked in.
already. We're
Now
locked in.
we're
Okay,
locked
so
in.
I want to make sure that I tell you beforehand.
Absolutely.
So it's kind of different than like a resale where like if you have a clause, you have to sign off and waive that
Yes.
condition,
Yes.
right? Where in this case, you automatically go for it.
Yes, it's by default.
Okay.
And that's the reason we keep in constant touch with you during that 10-day due diligence period. We'll be in touch at the 6, 8, and 9, let's say, and we're going to check in with you, make sure everything's on track, you're still good with the purchase, and day 10, we just congratulate you and you have the deal.
Okay, and then we just kind of sit back and wait, I guess.
Absolutely, for that passive appreciation to work.
Okay,
its
now
magic.
you did say that like obviously our team kind of gets a bunch of condos projects and we siphon them out and we get to around 6 to 8 that we get loud about. I presume that's because they just don't meet the threshold of the builder reputation.
Absolutely.
The what were some of the other things that you mentioned?
So the builder reputation,
the location,
the incentives. So every project has to make that cut before we bring it to our
and then
community.
of course the legal review as well, because you have the lawyer look into that ahead of time.
Right.
So we've helped thousands of investors use this strategy, but I'm hoping that you can go over how those investors have used this strategy to really build out their real estate portfolio.
Great question. And there are a lot of our clients who don't want to stop at one investment. It's like a drug, they say. They enjoy the process and they want to do it over and over again. So essentially what they do is a good drug. Absolutely. So essentially what they do is they close on a property, and during those 3 to 5 to maybe 8 years time frame, while they were waiting for this unit to close, they've seen an appreciation, let's say anywhere between 50K to 200K. Now, as soon as they close on the property, the values have gone up. So they refinance the very next day. Let's say the appreciation is 200K, the bank can give them 100K, right? They take that 100K, wait for the right project, invest it all over again, rinse and repeat. And the more number of units you have now, the easier it gets for you to keep investing, because multiple units are appreciating and taking advantage of the GTA market as a whole in terms of passive appreciation, and the easier it gets for you to keep repeating that process.
So it sounds like we covered a lot. I'm just curious, is there anything else that we've kind of missed that you hear a lot from investors or questions that you get?
Not in terms of questions, but one thing I will say, which is true for both you and me, is that we are real estate investors first, and then people who sell real estate as well. So we are very bullish on this strategy as a team, as a community. We've all invested in pre-construction. We've all made money in pre-construction. And when I talk to my clients, I really like to give my own example of the things that I have done and the way I have made money in the process. And essentially, this is the future of real estate as well in Canada, especially in the GTA. I mean, if we see, we have the green belt on top, that legislation came in a couple decades ago. We have lake on the south. So there's essentially only so much land that we have. So we're in a landlocked kind of situation here. And that is why we see the low-rise projects far and few in between, and the price points look crazy enough for most of them. So we can only build upwards.
So we kind of refer to it as the Manhattanization of Toronto.
Exactly. Yes. So this is the future. It makes for a very easy entry point for a lot of clients out there, be it a first-time home buyer or an investor. This is an easy strategy where people can, take it easy, make some deposit. It's kind of a forced savings plan as well, because they know the deposits are coming up at some point, so they save up, and hence it forces you to kind of use your money in a better way. And the last one being that, once you invest in a newer building, there's only so much that can go wrong. It's a newer building, it's not a house, mind you, so no furnace, AC and roof that need to be changed every 10 years. And it's a building, most of the things are going to be taken care by the management. So as a landlord, it's a very safe bet for you to invest in a new building, have tenants come in, and you sort it for the next few years. You don't have to worry about anything. So now that you know all about pre-construction, I will say this is not for everyone. So in case you're thinking about investing in pre-construction, reach out. We're going to discuss your exact plan, your long-term strategy, discuss the right projects for you, and see if it's a fit. If it is, we'll move forward. Feel free to reach out today, and I'll be more than happy to discuss.